Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 11th, 2025. Good morning, everyone. I hope you're all ready for a deep dive into the markets as we explore the developments that are shaping our economic landscape. Today's discussion promises a blend of hard numbers, incisive analysis, and yes, a few lighthearted moments along the way. So let's jump right into it.
Let's start with a quick market overview. The major U.S. indexes are providing us with a mixed picture this morning. The S&P 500 is trading around 5,587, showing a slight decline of about 0.29%. Not a huge drop, but it is one that signals caution among investors. Over in the Dow Jones, we're seeing figures around 41,491, which represents a broader dip of roughly 0.83%. It seems that the blue chip sentiment is wavering a bit today.
Meanwhile, the Nasdaq, in its characteristic tech-driven dynamism, managed to notch a modest gain of approximately 0.29%, climbing to around 17,494. There's an undercurrent of resilience in the tech sector here, even as indices such as the Russell 2000 are posting a slight dip, falling to roughly 2008, down by about 0.68%. For those who keep an eye on cryptocurrencies, Bitcoin is showing robust performance. It's up by approximately 2.75%, bringing its price to nearly $80,748, while Ethereum too is on the rise, gaining roughly 2.14% to settle at around 1,903. These crypto gains are injecting some optimism into an otherwise cautious market.
Now let's shift gears and embark on a deep dive into some of the major market trends influencing this mixed sentiment. One of the key stories this morning is the unfolding tariff fight between the United States and Canada. The ongoing dispute has had the effect of reversing gains in U.S. stocks, with the S&P index being dragged down by nearly 1% on the day. It appears that investors are reacting sharply to the uncertainty introduced by these tariff negotiations. The worry here isn't just about immediate financial losses, but also about what the long-term implications may be for bilateral trades, supply chains, and even consumer prices. I must say, if tariffs were a sport, we'd all be watching a nail-biting overtime finish every day.
In related news, we've seen significant activity among telecom giants. Verizon and AT&T have both experienced notable stock drops. Concerns over increased competition in the wireless industry seem to be weighing heavily on Verizon's shares and sending tremors through the sector overall. This isn't just about a few percentage points on a stock ticker. It's a signal that the traditional telecom business is in the midst of a fundamental shift. As more players and new technologies enter the competitive arena, established companies are feeling the pressure to innovate or risk lagging behind. It reminds me of a scenario where the tortoise suddenly finds itself racing against rockets instead of hares.
Further compounding the economic narrative, recent data on U.S. job openings paint a picture of a labor market that, while resilient in some pockets, is showing signs of a slowdown in hiring. Even though job openings in January experienced a slight uptick, there's an underlying trend where companies are becoming far more selective. The hiring process appears to be taking longer in many sectors, create a lag that could impact wages and consumer spending in the months ahead. It certainly makes us ask, in a world where a job search itself seems to be evolving into an art form, how do we keep talent engaged amid such uncertainty?
In the tech realm, Nvidia has been a hot topic recently. Its stock has been, in a word, brutalized, with investors exhibiting palpable anxiety about the state of artificial intelligence spending. However, there's an intriguing disconnect here. While some investors seem to be panicking, big AI customers are remaining resolute in their commitment to invest in future technologies. Could it be that the market is overreacting to short-term uncertainty, or is this a precursor to a more significant realignment in tech spending priorities? It's an interesting development that certainly demands close attention from any serious investor.
On the retail front, Kohl's is facing its own set of challenges. The company's stock has tumbled as it contends with a weak outlook and sliding sales. Kohl's CEO, Ashley Buchanan, has emphasized that the company has identified key areas that require urgent focus. This move appears to be part of a broader attempt to adapt to changing consumer habits and an increasingly competitive retail environment. When retail giants announce challenges like these, it makes one wonder whether we are witnessing the transformation of an entire sector or simply the inevitable pain of a mature market navigating choppy waters.
Adding a splash of market commentary from the celebrity analyst circuit, Jim Cramer has released his top 10 things to watch on the stock market today. Highlights include earnings forecast cuts from both Delta and American, as well as insights from Oracle pointing to continued momentum in their data center build-out efforts. Cramer's list, while sometimes theatrical, tends to capture the market pulse remarkably well. Whether you're a die-hard fan of his or a cautious listener, his notes today have undeniably stirred both debate and strategic recalibration among traders.
Shifting to an interesting acquisition in the sports technology space, Huddle has just announced its acquisition of Fast Model Sports. With this move, Huddle plans to integrate Fast Model's innovative tools with its own established strengths in video, analytics, and content expertise. This could potentially revolutionize how coaches and athletes prepare for games by offering unprecedented insights. It's a move that highlights the increasing confluence of sports and technology, a combination that is steadily rewriting the playbook for athletic performance analysis.
In the aviation sector, Southwest Airlines is undergoing a major transformation that is set to affect everything from bag fees to the structure of basic economy fares. Reports indicate that Southwest is now planning to charge customers for checked bags, alongside the introduction of basic economy tickets. This is a bold step aimed at boosting revenue in a fiercely competitive market. It's a reminder that even in industries where customer loyalty runs high, the pressures of financial performance can spur dramatic policy shifts.
In the world of mergers and acquisitions, H&IG Capital has completed its acquisition of Quisitive Technology Solutions, a premier provider of Microsoft Cloud and AI solutions. This successful arrangement underscores the ongoing appetite for cloud-based and artificial intelligence solutions as companies seek to enhance their technological capabilities and competitive edge. It's a classic example of how strategic acquisitions are not just about immediate financial gains, but about positioning for long-term growth in rapidly evolving industries.
Finally, on the compliance front, Fresh Fine Wine has regained its compliance on the New York Stock Exchange following its acquisition of Amaze Software. For companies that operate in both the technology and traditional sectors, such regulatory milestones are critical. They serve as important signals to investors that even in mergers that span disparate industries, due diligence and regulatory adherence remain top priorities.
Now, taking a broader look at these developments, it's time to delve into a detailed sector analysis covering technology, energy, finance, and some unexpected insights from retail and aviation. In the technology sector, we're seeing a fascinating dual trend. On one hand, the tech-heavy Nasdaq is proving resilient, buoyed by strong performance in areas like semiconductors, cloud computing, and artificial intelligence investments. On the other hand, high-profile companies like Nvidia are feeling the heat as investors wrestle with conflicting signals about the future of tech spending. Could the current volatility be a sign that the market is simply recalibrating after an extended period of growth? Or is it a harbinger of more profound shifts in how technology and capital intersect in our modern economy? These are the types of questions that keep us up at night, and they're central to understanding the trajectory of this sector.
When we look at the energy sector, a number of dynamics are at play as well. Although energy news didn't dominate today's headlines, the broader conversation around global energy security, climate change, and evolving regulations remains a constant background theme. Traditional energy firms are grappling with the twin challenges of ensuring profitability while also transitioning to more sustainable practices. Investors are keenly watching for signals as these companies adapt, especially in a market where the pace of change in renewable energy continues to accelerate. It's a balancing act reminiscent of trying to walk a tightrope in an unpredictable wind, challenging, but absolutely crucial for long-term success.
Turning our gaze to the financial sector, there is a palpable sense of caution in the wake of both tariff tensions and a slight cooling in the hiring market. Banks and financial institutions appear to be gearing up for potential disruptions, with many adjusting their risk assessments and investment strategies. The tariff fight between the United States and Canada has not only impacted trade, but has also introduced a measure of uncertainty that could ripple into lending practices and credit markets. In a way, it's like navigating through a storm where every gust of wind can change the course of your decisions, forcing both small and large investors to re-examine their portfolios carefully.
Retail has its own story to tell, as exemplified by Kohl's recent struggles. The company's turnaround strategy, although under pressure, could lead to a significant transformation if it manages to realign its operations and capture shifting consumer trends. Retail investors are likely to keep a close watch on how these companies adapt not just to changing market conditions, but to evolving consumer preferences in an increasingly digital world. And who knows, if Kohl's can reinvent itself, it might just serve as a blueprint for other retailers wrestling with similar challenges.
Aviation, too, is a sector that is undergoing transformative changes. Southwest Airlines' decision to charge for checked bags and introduce a new basic economy tier isn't merely a cost-cutting measure. It mirrors broader trends in the industry where legacy business models are being forcefully re-examined. In an age where consumers are both price-sensitive and demanding greater transparency, these changes could provide useful insights into how airlines may structure their pricing and service offerings in the future.
Now, stepping back to view the global market implications, what does all this mean on an international scale? The ongoing tariff spat between the United States and Canada is a reminder of how trade disputes can extend far beyond bilateral concerns. With global supply chains intricately interconnected, any significant trade imbalances can have ripple effects across various economies. Additionally, the evolution of technology and AI spending isn't something confined to Silicon Valley or Wall Street. It's a global phenomenon that affects economies from Asia to Europe. As countries vie to dominate in the digital economy, shifts in investment and strategic focus in one part of the world can quickly influence global capital flows. It's almost as if we are all part of one gigantic interwoven fabric, where a tug in one corner sends vibrations throughout the entire tapestry.
Expert insights and predictions in today's environment remain as critical as ever. Here's where you, as investors and traders, come into play. From my perspective, the current market volatility, then worrisome at first glance, represents periods of transformation that oftentimes lead to significant opportunities for those who can navigate the chaos with a clear strategy. Are we looking at the tail end of a cyclical downturn spurred by geopolitical issues, or is there an entirely new paradigm emerging, especially in tech and energy? It's a question worth pondering, and one that may well define the investment landscape for the months ahead.
I find myself reflecting on these developments with a mix of caution and optimism. On one hand, the drops in major indexes, coupled with the uncertainty fostered by tariff disputes and changing business models, suggest that the road ahead may be bumpy. On the other hand, the resilience in sectors like technology and the accelerating pace of innovation and artificial intelligence and cloud computing hint at fresh avenues for growth. The upward momentum in Bitcoin and Ethereum further underscores that while traditional markets may be wobbly, alternatives are providing robust returns. It's a bit like watching a tightrope walker who, despite the wobbles, keeps inching forward steadily, each misstep simply a prelude to a calculated leap.
Before we wrap up, let's consider some of the thought-provoking questions for you out there. How do you balance the contrasting signals between traditional markets and the dynamic world of cryptocurrencies? Are the current tariff issues just temporary distractions, or do they signal a deeper, more lasting realignment of U.S. trade policies? And in the ever-evolving landscape of technology, how should investors recalibrate their positions in companies that are simultaneously poised for explosive growth yet subject to sudden market corrections? These questions are at the heart of today's market debate, and I encourage you to mull them over as you consider your next strategic moves.
To summarize our key takeaways for today, major indices have shown a mix of cautious dips and modest gains, reflecting a market that is juggling a range of signals from tariff-driven uncertainty and competitive pressures in telecom to the transformative force of technology and AI spending. Key sectors, whether technology, energy, or finance, are all grappling with rapid changes, underscoring the need for agile strategies. Global implications, notably from the U.S. trade disputes, remind us that every local policy decision can have far-reaching ramifications in the interconnected world economy.
A special shout out to Pantheon AI, your information co-pilot, for keeping us all well informed with cutting-edge insights and data-driven analysis. Remember, the aim is not only to navigate the markets, but to understand the broader economic narrative. As we look ahead, think about how these trends might shape your investment strategies. Consider whether the current market volatilities are merely ephemeral jostles in a cyclical dance, or the early tremors of a paradigm shift that could redefine entire sectors.
I hope that today's discussion has provided you not only with a comprehensive overview of the market, but also with some useful insights to consider when making your own strategic decisions. In the end, markets remind us that every sudden drop or unexpected surge has its own story. The interplay of policy, corporate performance, global trends, and yes, even a bit of human humor. And speaking of humor, here's a little thought. Sometimes it feels like the markets are playing hide and seek with us, doesn't it? Just when you think you've got them figured out, they decide to disappear for a few moments, only to reappear with a surprise twist.
So as we wrap up today's brief, let's leave you with some food for thought. Are you ready to embrace the inevitable uncertainties and use them as springboards for greater opportunities? What strategies will you adopt in a market that sometimes feels like a game of chess, where every move counts and the board is constantly changing? And most importantly, where do you see the next big break? Will it come from an unexpected policy announcement, a breakthrough in artificial intelligence, or maybe even from a surprising twist in the way consumers choose to spend their dollars?
Thank you for joining me this morning on the PAI Morning Briefing. I do hope you found this conversation as engaging and insightful as I have. Remember, the key to staying ahead in the market is to stay informed, remain curious, and always ask the right questions. Don't forget to tune in again for tomorrow's episode. There's always something new unfolding in the world of finance. And if you ever have questions or need a guide on your market journey, our AI co-pilot is always ready to help.
Until next time, keep questioning, keep learning, and remember, learning should feel like a full-time job.